Silver is breaking down. The price is slipping, the chart looks damaged, momentum has clearly turned ugly, and now the biggest question is not whether the market feels weak. It does. The real question is whether this weakness is the start of something much worse, or the exact kind of panic event that happens right before the market turns and traps the crowd one last time. Right now, the numbers are feeding that fear. Investing's accessible silver pages showed spot silver, XAG/USD, around $64.9250, while silver futures were around $64.910. The same Investing Silver news snippet said silver had plunged 14.8% in a month and was now testing key support. Those are not small moves, and they're not the kind of numbers traders casually ignore. They create the exact emotional climate where people stop asking whether silver is volatile and start asking whether the breakdown is becoming real. And if you want the macro pressure behind the move, that's there too. The US dollar index was around 100.85, while the US 10-year Treasury yield was around 4.453% to 4.477%, depending on the snapshot. A firmer dollar and elevated yields are the classic combination that tends to pressure non-yielding metals. In other words, silver is not falling in a vacuum. It is falling inside a macro environment that still gives investors reasons to hesitate. But here is why this moment is so important. Silver is not just any market. It is one of those assets that can look completely broken right before it snaps higher and leaves late sellers stranded. That is especially true in a market where the longer-term supply story remains tight, the futures market remains active, and the price is falling into a zone that everybody can see. So yes, silver looks weak. Yes, panic selling has started to feel real. But that does not automatically answer the deeper question. Is this the start of a bigger collapse, or the final shakeout before a reversal? So in this video, we're going to break down exactly what is happening in silver right now, why the chart suddenly looks so fragile, what the macro pressure is doing, why the futures activity matters, why this market still has a longer-term bull story underneath all the damage, and whether the current panic is the beginning of a true breakdown, or the kind of emotional flush that often happens near important turning points. And as always, this is market commentary and education only, not personal financial advice. The first thing we need to do is separate two different ideas that people often confuse. 1. Silver is clearly under pressure. 2. Silver is definitely headed much lower. Those are not the same statement. The first one is obvious from the data. The second one is still a debate. Spot silver around $64.93 and futures around $64.91 tell you the market is trading in a stressed zone. A 14.8% monthly drop tells you this is not a harmless dip or a random intraday fluctuation. It tells you silver has already gone through a meaningful repricing wave. Markets do not lose almost 15% in a month without damaging sentiment, shaking out weak holders, and forcing both traders and investors to reconsider their assumptions. That part is already happening. But then comes the harder question. What kind of market usually forms after this kind of decline? Sometimes a market falls 10%, then 15%, then 25%, and the breakdown just keeps feeding on itself because nobody wants to step in front of the selling. But sometimes a market falls hard enough, fast enough, and emotionally enough that it creates the exact conditions for a violent countermove. That's why silver gets so much attention during moments like this. It is one of those rare markets where panic and opportunity often appear in the same candle. That is why I would describe today's silver action like this. The breakdown in price is visible, but the meaning of that breakdown is not settled yet, because price is only one piece of the story. We also need to look at the backdrop, the structure, and the participation. The reason your title is so strong is that it taps into the exact psychology silver is creating right now. Silver is breaking down, panic selling has started, but is this the final shakeout? That works because it contains two emotional truths at the same time. The first emotional truth is fear. Silver looks bad. A 14.8% drop in a month is enough to make people question the entire bullish case. When price falls through levels people thought were safe, and when both spot and futures are sitting near the same weak zone around $64.9, it becomes much easier for the crowd to imagine lower prices than higher ones. That's how momentum breaks confidence. Source. The second emotional truth is suspicion. Silver has a long history of flushing traders out right before reversing hard. When a market with a still active long-term narrative suddenly becomes universally uncomfortable, people start wondering whether the move is real, or whether it is one more trap. That is the power of the phrase, final shakeout. It doesn't deny the damage. It asks whether the damage is the last scare before a rebound. And that is exactly the right frame for silver. Because silver is not a calm asset. It is not a slow-moving utility stock. It is not a low-volatility bond proxy. It is a highly emotional, precious, and industrial metal that lives at the intersection of inflation expectations, real yields, dollar strength, industrial demand, speculative futures activity, and physical supply questions. That means the market can look terrible and still remain one strong catalyst away from a sharp reversal. So yes, this title works because it feels dramatic. But more importantly, it works because it is structurally honest. Silver really is at one of those points where the breakdown is visible, the selling feels emotional, and the next major move matters more than usual. Whenever silver starts breaking down, one of the first questions you should ask is simple. Is this a silver-specific problem, or is the broader macro environment also leaning against it? Right now, the answer looks like this. Macro is not helping. The dollar index was around 100.85, and even if you catch slightly different feed values like 100.81, the message is basically the same. The dollar remains firm enough to be a headwind rather than a tailwind. Precious metals usually do better when the dollar is softening in a meaningful way, because a weaker dollar tends to improve the relative appeal of hard assets. But that is not the backdrop silver is getting right now. Instead, it is dealing with a dollar that still has enough strength to keep pressure in the system. Then look at yields. The U.S. 10-year Treasury yield was around 4.453% to 4.477%, with CNBC showing an open of 4.477%, a high of 4.477%, a low near 4.42%, and a previous close around 4.463%. Those are still elevated yield levels, and that matters because silver does not pay interest. So when government yields remain high, the opportunity cost of holding silver stays real. Investors do not have to be bearish on silver to hesitate. They just have to believe yield-bearing assets still offer enough competition. And this is what makes the current silver drop more serious than a random chart wobble. Silver is not just falling because somebody hit the sell button. It is falling inside an environment where the macro logic for owning precious metals is not especially powerful right now. The dollar is not weak enough to rescue the market, and yields are not low enough to create a naturally supportive backdrop. That does not mean silver cannot reverse. It means if silver does reverse, it will probably have to do so in spite of the current macro climate, not because macro is making it easy. And when a market has to fight uphill like that, the price action often becomes much more violent. One of the most important details in your data is not the spot price, it is the activity, because panic feels more serious when traders are actually showing up in size. CME's metals volume page snippet showed 100-ounce silver futures volume at 21,994, with open interest at 14,304. That is a critical clue. It tells us that silver is not drifting lower in an empty market. This is not a lazy, low-participation slide where nobody cares. This is a move happening while traders are still very engaged. That matters for two reasons. First, active volume during stress makes the move look more real. When a market drops on thin liquidity, you can sometimes dismiss it as air pockets, bad timing, or exaggerated intraday noise. But when tens of thousands of contracts are trading and open interest remains substantial, the price move carries more weight. It suggests the market is being actively repriced. Second, active participation creates the possibility of a sharper next move in either direction. Why? Because if traders are still heavily involved, positions can still be squeezed, trapped, or forced to rotate. Inactive markets tend to drift. Active markets tend to lurch. So the same futures activity that confirms the seriousness of the breakdown also supports the final shakeout theory. Heavy stress with heavy participation is exactly the kind of environment where weak hands can get flushed out, and where the next reversal, if it comes, can arrive with force. Source. This is why the smart money angle in your alternate title also works. Silver breakdown. Alert. $64.93. Spot. 21,994 CME contracts traded. Are weak hands getting trapped? That works because it introduces a more sophisticated layer to the story. Instead of focusing only on fear, it asks what kind of positioning is happening inside the fear. And in silver, that is often where the real story lives. Because silver doesn't just move on emotion, it moves on who is forced out of the trade. Section 5. The longer-term silver story is still strong, and that's why this drop feels so conflicted. If silver were just another commodity with no underlying story, this decline would be easier to classify. But it isn't. And that's what makes this market so difficult and so interesting. Reuters reported earlier that the silver market is still expected to post a sixth straight annual structural deficit, widening to 46.3 million ounces in 2026 from 40.3 million ounces in 2025. Reuters also said that 762 million troy ounces had been drawn from stocks since 2021. That is not trivial background noise. That is one of the strongest medium-term bullish narratives in the whole precious metals space. This is the story that keeps silver bulls engaged even when price action gets ugly. Because structural deficits mean the market is using more silver than it is comfortably replacing over time. That does not guarantee immediate upside, and it does not eliminate short-term corrections. But it creates a very important condition. It means the silver market remains vulnerable to stress if investment demand returns, if delivery activity becomes more important, or if macro pressure eases at just the wrong time for shorts. That is why the market feels so conflicted right now. On one hand, the chart looks weak. On the other hand, the supply story still looks tight. On one hand, macro is leaning against silver. On the other hand, the market still has a deficit narrative strong enough to matter. On one hand, price is falling and emotion is turning sour. On the other hand, silver is not a market where everybody can safely assume the downside will continue in a straight line. This is the exact kind of contradiction that creates the best and hardest silver setups. Because the market is forcing participants to decide which story matters more right now, the ugly tape or the strong structure underneath it. Reuters said on May 11th that silver may be on the road to recovery after stabilizing from its March slide to a 3-month low of $60.94 per ounce. That report pointed out that silver had climbed back above key downtrend lines after earlier collapse damage, suggesting the market might be trying to recover. But even then, Reuters made it clear that the metal remained volatile and technically vulnerable. Source. That matters now because it reminds us that silver's recovery was never clean. The market did not transition from panic to stability in a neat, trustworthy way. It stabilized, yes. It attempted to recover, yes. But it never fully escaped the emotional volatility that defines silver after a big blow-off and crash. So today's breakdown is not coming out of a perfectly healthy uptrend. It is hitting a market that was already trying to rebuild trust after major damage. That makes the current drop more dangerous, but it also makes the final shakeout idea more believable. Because markets coming off deep prior damage often go through several trust tests before a real bottom forms. They don't just bounce once and go straight up. They scare buyers. They force capitulation. They create false dawns. They make people feel stupid for staying optimistic. Silver is exactly the kind of market that behaves that way. So when you ask whether today's selling is the beginning of a deeper breakdown or the final emotional flush, the Reuters recovery context matters. It tells us silver had been trying to heal, but it also tells us that healing was fragile. And fragile healing often looks terrible before it either fails completely or suddenly proves itself. A lot of viewers focus too much on one session, one bad day, one ugly headline, one scary futures print. But the more revealing number in your data is not just spot at $64.93 or futures at $64.91. It is the statement that silver has fallen 14.8% in 1 month and is now testing key support. That changes the whole interpretation, because once a market is down almost 15% in a month, the decline is no longer a mood swing. It becomes a trend event. It starts changing positioning, media framing, investor psychology, and institutional confidence. People stop viewing it as noise and start viewing it as a verdict. And that is exactly why shakeouts become possible here. Because the more a market convinces people that the trend is now obvious, the more dangerous the next move can become if the crowd is late. This does not mean silver must reverse now, but it does mean silver is now deep enough into pain territory that the market may be approaching one of those levels where psychology becomes more important than headlines. Late bulls are uncomfortable. Early dip buyers are wounded. Short sellers feel smarter. Neutral traders are watching for confirmation. That is often the emotional recipe for either a clean breakdown continuation or a vicious short-term reversal. And that is why the monthly damage matters, because it tells you silver is no longer in the maybe this is just a normal pullback phase. It is now in the market has to prove what this really is phase. One of the easiest mistakes traders make is thinking in absolutes. They assume if the dollar is firm and yields are elevated, silver simply cannot bounce. That is not true. What is true is this. A firm dollar and elevated yields create a difficult environment, but difficult does not mean impossible. A DXY around 100.85 is a headwind. A 10-year yield around 4.453% to 4.477% is a headwind. But neither one is a mathematically final verdict. This distinction matters because it helps explain why both camps still have a case. The bears can point to macro and say, look, silver is under pressure for a reason. Real competition from yield still exists. The dollar is still firm. This market has every reason to stay weak. And the bulls can respond, yes, but silver is already down 14.8% in a month, despite that macro story already being visible. If the market was going to completely collapse on these conditions, shouldn't it be doing even worse? That is the argument. Macro explains the fear, but macro does not fully settle the outcome. In markets like silver, that unresolved tension is exactly what creates the best drama. Because if macro begins easing even slightly, a softer dollar, a dip in yields, a shift in sentiment, then a metal that is already heavily sold can react very quickly. The downside case often looks strongest right before the macro pressure stops intensifying. Again, not a guarantee. But this is why experienced traders do not just look at macro conditions. They look at whether those macro conditions are getting better, worse, or simply no longer worsening fast enough to justify continued panic. That is the subtle question silver is forcing the market to answer right now. This is what real panic selling usually feels like. If you want to understand whether panic selling has started, don't just look for red candles. Look for the emotional pattern. Panic selling usually has a few recognizable features. First, price starts falling in a way that feels heavier than usual. Second, the media framing shifts from volatility to support break. Third, traders stop asking how high it can go and start asking how low it can fall. Fourth, volume and participation remain active because people are still reacting. And fifth, the market begins testing levels that matter psychologically, not just technically. Silver is showing multiple elements of that pattern right now. The 14.8% monthly drop changes the emotional tone. Spot and futures both sitting near $64.9 make the weakness look synchronized. The testing key support framing reinforces stress, and the CME activity tells you this is not passive price drift. That doesn't mean full capitulation is over. In fact, one of the hardest parts of reading silver is that real capitulation often doesn't feel complete when it happens. It just feels ugly, exhausting, and increasingly obvious, until suddenly the market stops going down and the whole crowd has to reassess. That is why the phrase panic selling has started works well, because the market has clearly entered a more emotional stage. The question is whether we are still in the middle of that emotional wave, or near the end of it. Section 10. Could this actually be the final shakeout? Here's the bullish case. Let's make the bullish argument clearly and seriously. The bullish case is not that silver looks great right now. It doesn't. The bullish case is that silver may be entering the kind of emotional sell-off that often marks a late-stage flush rather than a fresh, clean, bearish trend beginning from comfort. Here's what supports that view. Silver is already down 14.8% in a month. Spot and futures are both sitting in the same stressed zone near $64.9. Futures participation remains active, and the longer-term supply backdrop still points to persistent structural deficit. Source, 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 source. In other words, silver is not dropping from a position of optimism into mild weakness. It is dropping from a position where a lot of pain has already happened and where a lot of traders are already emotionally leaning in one direction. That is exactly where final shakeouts often form. The market doesn't need to make the bullish case look comfortable. It often does the opposite. It makes the bullish case look foolish first. It breaks support, accelerates fear, and forces out people who are hanging on for a bounce. Then, if the selling exhausts itself and macro pressure stops getting worse, the reversal can arrive violently. That does not mean silver must bounce tomorrow. It means the market is now deep enough into pain territory that the final flush theory deserves respect, especially in silver, because silver has a habit of punishing certainty. Now let's make the bearish case with the same honesty. The bearish case says, this is not a final shakeout. It says this is a real breakdown, driven by a hostile macro backdrop, failing momentum, and a market that is finally giving up on the recovery narrative. That case has real evidence behind it. Silver is in the mid-64s, not the mid-70s. The monthly decline is already severe. The dollar is still strong enough to pressure metals. Yields are still high enough to hurt non-yielding assets. And panic selling has clearly become part of the narrative. The bears would say this: look, the structural deficit story may be true, but stories do not automatically stop liquidation. A market can stay weak a lot longer than people think if financial conditions are wrong. If yields stay elevated, if the dollar stays firm, and if silver keeps failing to attract real buying, then this breakdown can continue much further than the bulls want to believe. And that is absolutely possible, because a strong long-term thesis is not the same thing as short-term price support. Markets can ignore good narratives for surprisingly long periods. That is why this silver setup is so difficult. The bullish case is intellectually credible. The bearish case is visually credible. One side has the structure, the other side has the tape, and right now in the very short term, the tape is winning. Section 12. What should viewers watch next? If you're following silver after this breakdown, the next step is not to fall in love with one narrative. The next step is to watch for confirmation. There are a few things that matter most from here. Watch whether spot and futures continue syncing together. If both remain locked in step lower, that strengthens the breakdown story. Watch the dollar. If DXY keeps climbing decisively above the current area, silver may face even more pressure. Watch the 10-year yield. If yields push higher again from the mid-4.4% range, that keeps the macro headwind alive. Watch futures participation. If volume remains heavy during weakness, the move stays serious. But if silver suddenly stops falling while activity remains high, that can be an early clue that forced selling is being absorbed. And most importantly, watch silver's behavior around support psychology. A market that truly collapses usually loses support and stays weak. A market in a final shakeout often breaks confidence first, then stabilizes faster than the crowd expects. That is the distinction that matters now, not whether silver is red today, but whether silver can keep extending the downside after fear has become obvious. Because once fear becomes obvious, the market stops being about information and starts being about who gets trapped next. Closing section. So, is this panic selling or the final shakeout? Here's the bottom line. Silver is clearly breaking down. That part is no longer the debate. Spot around $64.93, futures around $64.91, and a 14.8% monthly decline make that obvious. The market is under pressure, support is being tested, and the emotional tone has turned much more serious. A firm dollar and elevated Treasury yields help explain why the weakness is happening, and heavy CME activity confirms that traders are still very engaged during the stress. Source. But the deeper question is still unresolved. Is this real trend failure, or the final emotional flush before the market finds its footing? That is where the longer-term silver story still matters. Reuters' structural deficit report keeps the supply tightness argument alive, and silver's own history reminds us that emotionally damaged markets can reverse hard when the crowd leans too confidently in one direction. Source. So the most honest answer is this. Yes, panic selling has started to feel real. No, that does not automatically mean the downside is finished, or that it must continue. Silver is now in the kind of zone where the next move matters enormously. And in markets like silver, those are often the moments people remember later and say, that was the point where everything changed.